One of the most expensive investing mistakes I see isn't buying bad investments, it's selling good ones. Every year, investors are told to sell their best performing assets and move that money somewhere else in the name of proper portfolio management. The problem is that nobody can tell you with certainty what your portfolio is actually supposed to look like. Not 60-40, not 70-30, not 80-20, yet people create tax bills every single year trying to maintain a ratio that nobody can prove is optimal. Today, I'm going to explain why portfolio rebalancing is often overrated, when it actually makes sense, and 2 simple ways to rebalance without unnecessarily handing money to the IRS. Portfolio rebalancing is the idea that you should decide on your perfect portfolio structure, such as 70% stocks and 30% bonds, and stick to it like a religion. If your stocks do really well one year and become 75% of your portfolio, the textbook advice is to sell some stocks and buy bonds just to get back to that target ratio. But here's the problem. No one knows what the perfect balance actually is. And more importantly, the textbook doesn't account for your taxes. Let's take a well-known structure, the Bogglehead 3-fund portfolio. Generally, they recommend somewhere between 50% 80% of your assets in US broad market index funds, maybe 0 to 20% in international funds, and the remainder in bonds. But even with this widely respected framework, there are huge differences. One investor wants 0 international exposure, another wants 20%, one person wants more bonds, another wants none. Can anyone tell you with certainty which version will produce the best outcome over the next 20 years? Of course not. These are educated assumptions, not guarantees. So if nobody knows the perfect allocation, why should you be obsessing over maintaining a precise ratio year after year? When you rebalance, you often have to sell the assets that perform the best. In a taxable account, that can create capital gains taxes immediately. In other words, you're voluntarily writing a check to the IRS just to maintain a ratio that may not even be the right ratio in the first place. Then there's the additional work of deciding what to sell, when to sell it, and how much to move around. The traditional argument is that your allocation should become more conservative as you age. And for someone already retired and living off their portfolio, I completely understand that logic. But for investors with decades left before retirement, rigid rebalancing is often overemphasized. I've seen clients build enormous wealth through real estate while having very little in traditional retirement accounts. I've seen people make life-changing money from concentrated positions in assets like Bitcoin. I've also seen people lose money doing the exact same thing. The point isn't that concentration is always good. The point is that nobody knows in advance which asset classes will outperform over the next 10, 20, or 30 years. So, if an investment is performing exceptionally well, should you automatically sell it simply because it exceeds an arbitrary percentage target? That's a much more complicated question than most rebalancing advocates make it sound. The tax smart strategy. If you love the idea of having a portfolio that stays within a certain range, stop selling your winners. Stop creating unnecessary tax bills. Consider these 2 options instead. Number 1, the new money technique. If your stocks went from 70% of your portfolio to 80% and you want to keep it at 70-30, don't sell them. Don't buy bonds by offloading your stocks. Just buy bonds with your next paycheck or your next contribution. This will slowly get you back to your desired portfolio without ever creating a taxable event. Number 2, the retirement container technique. If you have $100K in a Roth IRA, $100K in a traditional IRA, and $100K in a taxable brokerage account, and you want a 70-30 portfolio, don't touch the taxable account. If your stocks in the taxable brokerage skyrocket, leave them alone. Instead, sell your stocks inside your retirement account to buy bonds. Because it's inside the IRA, you pay 0 capital gains tax. You achieve your desired 70-30 split, but the IRS gets $0. Doing nothing is also a valid strategy. It's called portfolio drift. It allows your winners to continue compounding without constantly interrupting them in the name of maintaining a perfect allocation. That doesn't mean rebalancing is always wrong. It simply means that taxes, personal goals, risk tolerance, and time horizon matter far more than blindly following a textbook formula. My firm focuses on proactive, tax-efficient planning, not just investment theory. If you're tired of generic advice and want to know whether your portfolio actually needs rebalancing, click the link below to book a free consultation. Let's look at your situation and determine whether you're creating unnecessary tax bills or simply allowing your wealth to grow tax efficiently. Thank you for watching. Don't let the textbook dictate your taxes. Start planning.